Today we're going to do the Chapter 7 foreign currency translations. These are for financial statements. And next week is week 6. You say, well, big deal. Well, but week 7 is our break. So what I'm planning on doing is for Chapter 6 and Chapter 7, next week I'll do the practice exam. And then if you guys want to take the exam that day, those of you that are playing along at home, I'll send out the the exams to you. I'll send the exams to everybody, but if you're in the classroom, you want to take it, I'll take it that way also. But anyway, so what I want to do is go away for week 7, clean that we don't have anything else. So anyway, next week we'll do the practice exam for 6 and 7. One other thing I want to check on, I'll put it in here. Everyone should have gotten, been emailed, the chapter 1, 2, and 3 exam and the chapter 4 and 5 exam. Now, if you weren't emailed those, let me know. It's come to my attention that some people didn't get it. So if you were not emailed these, let me know and I will get them out to you. Okay. So let's see, today, nope, don't want that. And I'm going to do this in Excel again. What I first want to do is go over these, kind of the rules that we have for what we're going to be doing. And these are on your handout. These are pages 5 and 6, I think. I got the handout right here. Let me look. Yep. Okay, so we basically have 2 different kind of sets of rules here. It's something wrong here. Okay, so here's kind of the deal that we have for, there's 2 sets of rules we have for taking the financial statements and converting them into US dollars. Translating. So chapters 4 and 5 were all about getting the international standards converted over to US standards, basically. This one is converting those financial statements into US dollars. Now, usually there's actually a 3rd step, and the 3rd step, well, it could be a 3rd step. The third step is to consolidate them. And that will be in your advanced class, which I think is 414. Someone may be taking that now, but so 414 is where we actually combine those together into consolidations. But and that's where you kind of take the 2 financial statements, or 2 or 3 or how many there are, and you kind of smash them together. It's a little more complex than that, but where you combine them. So anyway, so this is converting them into US dollars. Now, they come in 2 different flavors. And the first one is, if the operations are, if they take the cash flows and put them directly into US dollars, in other words, the cash flows from the international investment business are folded into the US company. So that's what this first one is, the temporal method. Now, it could be folded into it could be that they're a country that has high inflation or something, and you convert it into US dollars. It could just be that they convert into US dollars just as a matter of that they want those in, the dollars from the international. It could be they need them too, for the international companies. So the temporal method is for those companies that are very much integrated into the U.S. company. The second one is when they are not. That's when we just kind of leave them alone. I'll get somebody like it. And we let them do what they need to do. So if they need, if this kind if the foreign subsidiary, wherever it is, it's in Thailand, we're going to let them just do their stuff in Thailand. We're not going to take their cash flows or anything like that, or fold them into ours, or ours go to theirs. None of that stuff. We are going to simply let them, work as they are. And that one is actually a little bit less complex because we don't really do too much with the translation because they're not directly translated into US dollars. They are, they exist in their currency, whatever their local currency is. They exist there, and it's sort of like almost like a very current market for the currencies rather than going into the historical ones. Because the temporal method, it assumes everything is immediately gets transferred into US dollars. So a lot of the stuff is historical cost, and once that gets translated, it's left there. Whereas this one's a little more free floating. Okay, now we have, so here are the two different methods. This is actually on page 6. And this is what we're going to use to translate these. And it's a little bit like baking a cake or something like that. They tell you, go get this, and you go get it, For instance, the revenue is going at average cost. Okay, go find the average exchange rate. You go get it, plug it in. That's kind of how you do it. Well, let's jump right in. It's something that might be harder to explain it than it actually doesn't do it. Okay, so let's take a look at this first one here. Now, it goes by the functional currency. If the functional currency is US dollars, it's this one. If the functional currency is the foreign currency or the local currency, it's the current rate method. So which method are we going to use? The temporal or the current rate? Current rate. This one is in British pounds. And the method used will be the current rate. So we're going to use the current rate method, which is this one. You know what I'm going to do on this one? I'm going to hide temporal rate because we're not going to use it right now. This still might be a little bit clunky. I was hoping that this would. Come on, get over there. It's not cooperating. Oh, I'm just going to leave it. Okay. All right, so let's go to revenues. Now, think about revenues. They generally, they happen throughout the year. And so what they usually do is they take an average of them. You can tell right now this is not going to be very easy to do unless I do change it. Okay, new plan. Here's my new plan. This over. You don't have to do anything with this. This is just me talking to myself. Because I want to get the it's kind of there. Okay, so here is the current method. So revenues, we're going to use the average. So we're going to come up here and find the average. It's this one. We'll make that. Nope. We'll make that orange. Okay, so I'm going to take this orange one. And I'll go ahead and multiply. Yeah, you can just copy what I'm doing for multiply. Oops. Let's. Okay. So the revenues, what are these British pounds? Way to get rid of all this. Oh, wait a minute. There is a way to get rid of all this. We just do this. Hey, look at that. See? You delete it. All right. So okay, so revenues are going to go at the average. And the reason they're at the average because throughout the year you make your sales and they'll be on average. Okay, cost of goods sold would we use? Average. And you'll kind of see that for most of these, they're all going to be average. Most expenses are going to be average. Uh, Operating expenses without depreciation. Average. Depreciation expense. Average. We're going to stop right there for a second. And let me fill these in. Okay, so most of the stuff on the income statement is going to be average, and that's true even with the temporal method for the most part. Can I just drag this? Hey, I can. Let me zoom in so you guys can see it. So we just put everything in at the average cost. You know, I'll read them out to you. Cost of goods sold. Oh, excuse me. Say revenues are 500,000. Cost of goods sold is negative 390. This actually shouldn't be there. Oops. This should be a calculated one. It should come out the same, but and this one should be 125. So our gross profit is 110, and that's in US dollars. The operating expenses without depreciation are that, and depreciation is the same. And again, we're doing that because it tells us to do that over here. Pretty much everything goes in at average for this current method. And remember, this is the one that we leave it in the foreign currency. We leave it in the local currency. Now, this gain on sale of equipment, This one is a little bit special. This one did not happen throughout the year. It happened on 4/30/26. So we're not going to use the average for that one because we know exactly what that was on that date. It was that. I'm going to copy that down. And I'll sum it up here. Now I want to show you something here. If you when we're looking at this, you look at the income calculated and it says it's a composite rate. In other words, it's made up of a bunch of different rates, and you can see that already in this one because it has 125, the average, but then it also has this 122. There is no one rate for this to get translated over. I mean, you could figure it, you could make up, you could divide it and see what it is. But it's not just one rate, it's several rates. And it could be many different rates depending on what's going on in the company. So when they say composite, you say, well, what does that mean? Well, it just means that it's more than one rate. It's not a single rate. Yeah.
22.
Oh, is that even wrong? Oh, that's because this is at this date at the, is that 4/30? And so this one, it could be, and the inventory historical is a little bit, it can be a little bit complex because it can have many historical rates in it, and they'll give an average of it. Yeah. And we'll run into that in the next one. Okay. Now, retained earnings. I think I cut too much off this problem. This actually came out of the book, but or a similar one in the book. I think what I cut off is that this company was originally started on the first of the year on 12. Scratch that. January 1st, 2026 was this when it was in this place things started. So when we come down here, the beginning retained earnings, this is what we bought in at the beginning of the year. We're going to use the historical for that for the 121. You can have a bunch of historicals. Truthfully, this one is a historical cost. Whatever the inventory is going to be historical. This is up here is historical. So you could have many different historical costs on there. And this one is a historical also. I'll put it in. But we're going back to the historical for beginning of the year. So this is when we bought the company, this is what it was. And let's give that a color of, is that too dark? I think it works. Okay, so the beginning retained earnings would have been 197,600. Okay, now this net income is a composite rate. We don't actually, we're just going to bring that down exactly like it is up there. This is 42,320. I usually don't drink in class, but I'm feeling a little down today. It's just, if it was beer, I'd share it with you guys. Salud. All right. So here's the income's a composite. And dividends declared and paid were, oh, on 9/1. Okay, so we had to figure out what 9/1, what was the, and this is also historical. Was it on that date? Oh, that one. Okay, so 9/1, another historical one. It's green. Oh, it can't be green, you guys. I just realized we already got green for composite. All right, we got to start all over. Here we go. Okay, so we're going to multiply that 12,000 times 1.26. So that's what on that date, that's how much we paid out. 12,000 pounds. That was a translation rate. So this will be what we paid out on that date. And is that right? Let me make sure. Yep. Okay. Now, what do we have to do? We have to add all these up. And that's going to be a composite. And if you look over here, it should say that retained earnings is going to be a composite. Now, the first one we had was historical, but after the first go around, it's a composite. And retained earnings is a composite. We have two retained earnings there. What are those? Oh, I know what that is. Okay. Oh, first one's historical, subsequent ones are composite. Wait a minute, I don't need that. It's the same on this one. All right. Now, the balance sheet. Notice the balance sheet is different than the income statement and even going into the statement of retained earnings because the income statement is over a period of time. How much is it for this year? So it's for the entire year. So that's why we use the average. The balance sheet, everything is at the end of the year, end of the period, whatever it is. So it's, on December 31st, how much cash do we have? December 31st, how much inventory do we have? December 30, you get the idea. It's that year end. And that is the term for that they use is the current rate. And that's the year end. And let me make sure. Let me show it here. Let's go down here. You'll notice something about how great this one's going to be to do the balance sheet. What rate do we use? Current. Pretty much everything is at current. The only thing that's not at current are these. Oops. The equity section, but everything else is at the current rate. And the reason being is that none of this stuff has been transferred into US dollars yet. It's all sitting in the local currency. Wait a minute. So the current one is really at year end. What was the rate? And I'm not sure why they call that current. I guess the current year end. It's something. Those of you that are playing along at home, are the shadings too dark? It's hard to know what they come out like. It's different on my screen than it is on the screen in here.
I can tell
Nope,
the
it looks
difference.
good.
Okay. Okay, so current rate, 132. And that's going to be for everything. In fact, you can even do the total assets with it. Okay, so let me multiply these out. and I'll go ahead and read them to you guys. So cash will be $58,080, 58,080. The receivables will be 84,480. The inventory is 132,000. And the property, plant, and equipment is 237,600. So 237,600. And the total is 512. I think I'm going to make that a special color because we're going to use that later. Okay. Oh, let's look at the liabilities. And again, these are going to go in at current. We only have two of those. Okay, common stock. Now we bought this. Remember we bought this company on January 1st, 2026. I don't have that in there, but I told you guys later. And so basically these first two, retained earnings and then the common stock. This is really what we bought it for, basically. When we bought this company, what are these pounds? We basically bought 152,000 of beginning retained earnings in pounds, and we had common stock of 58,000 in pounds. So these are all going to go back to the historical first day of the place. This first, this is when we bought it. We got the stock and retained earnings at 1/1/2026. So those are going at 130. So the common stock will be 75,400. And by the way, that one's going to stay the same forever. Well, I mean, as long as we don't change the common stock or sell it or anything like that, it'll be the same. It could be the same for 20 years. Retained earnings we already have. It's a composite. It's that number. Change it back to green. So this will be green. Kale, insert an arrow. Maybe I don't see the arrows. Hey, where are we? Where is it? What? Where is my? Oh, here it is. Oh, that crying for no reason. All right. Let me format this. Give me a second so that we can actually see it. Okay, so this is this is that. You just bring it down one number, and it's a composite. And yeah. Okay, now we're going to sum them up. And immediately, what strikes you as odd about this? Or a problem, possibly? Yeah, balance sheet is supposed to balance, and this one does not now because we did these translations and they don't. So the question is how much, what's the difference? And we're just going to subtract them. So 512, 160 minus. Okay. So the difference between the total liabilities and equity is $6,040. Now let's think about this for a second, whether this can be a gain or a loss. Our assets, our stuff, we have 512,000. And the things we owe to creditors and the owners is 506,000. What do you say? It's a gain. Yep. Yeah, we must have gained 6,040 on the translation. And again, this is on the translation because in the local currency, it balances, but when we do the translation, it doesn't. So this will be a gain. Oops, that's not how you spell gain. Okay, now the question is, what do we do with that? Well, if it's a temporal method, it goes through the income statement. We're not in the temporal method, we're in the current rate method. So this is actually going to go into the equity section. So this will actually be in the equity section. Now we could add it. We could add a row in here if we wanted to. What I want to do? No, if I do that, I'll mess it up. So what would they do? Is this be a gain will go in the equity section? It'd be a plus. Now this does not go through the income statement. It goes right into the equity section of the company. So you're not going to see it on the income statement. And the reason is this could reverse out in the next year. Look at all these things that go in at the current rate. For instance, the balance sheet. Well, that current rate changes. It could change this. If that current rate drops down or something, it could change. It could change. So this could fluctuate, and because of that, it's going to go through the equity section. And two, this isn't a real dollar amount. What I mean by that is this money has not been transferred into US dollars. Yeah, it's still in the local currency. It hasn't been, included in our US dollars. So from the US point of view, this is not a completed cycle or a completed transaction. Nothing has actually happened. It's just the value of it is changed. And we're going to pick up the gain and put it into our equity section. We're not going to show it on the income statement. It'll simply be on, it's kind of like a note almost in the, are you guys taking advanced accounting right now? Anyone? No. In advanced accounting, what you would do with that is it would be just added in to the parent company. Do I have one to show you guys? Oops, that's not even close. I think it's is it 414? Four fourteen, what it would look like. Some lazy teacher didn't finish that one. All right, let's try. Oh, I know why. I don't have the. I'm missing a bunch of them. Oh, here we go. Let me try something different. There we go. This is what I meant to show you guys way back when. All right. So this is kind of what they do when they take the two companies and smash them together. And so you would take, so once you translated these into US dollars, and generally you say, okay, well, how big does the subsidiary have to be? You know, if you have a small company, for instance, you have Microsoft take it over, do you actually combine that? You know, do you take a $5 million company and combine it with a $500 billion company? Generally, the rule is it's basically a 10% rule. If it's 10% of your revenues, 10% of your assets, 10% of your income, 10, you know, what if it's 10% of almost anything, then you combine it. If it's not, you generally don't. So anyway, so this is one that they've taken and combined them, and when you do that, it'll look like this. When you read a company's financial statements, they say consolidated financial statements, you only are seeing that. Whereas actually, they have all this other stuff in there. You know, they could have one, two, they could have 20 companies in there. Actually, they probably couldn't have 20 companies because that would not be 10% of their revenue usually. But anyway, you have a whole bunch of different companies in there that would be combined. These are just combining journal entries. When you get there, you'll find it out. But this is when you take the two companies. So this would be a foreign, you know, subsidiary, a foreign subsidiary it would be in here. Could be in there anyway. Oops. That's not how you spell it, but that E should be I. So if you have a foreign subsidiary like we're doing here, whatever this company is, you very well could be combining in with yours. If it's, like I say, it's 10% of anything, basically, it'll get combined. Okay, question on that? All right, let's go to the next type of problem we're going to have, and that is on page 2. Notice that the functional currency is in US dollars. And so the method we're going to use is the temporal method. Copy this over. And I'm going to make an adjustment here because we now don't want the current method. We now want the temporal method. And the temporal method is a little bit The temporal method is going to be a little bit more involved. They do a lot of stuff at historical cost. The biggest ones are going to be here, cost of goods sold. And the inventory, you'll notice it has two different ones there, inventory at market and inventory at historical cost. Remember way back when, chapters, how did we do that? That was at chapter 1, 2, and 3, I think. No. It wasn't. It was 4 and 5. The lower of cost or net realizable value. Here's where it gets even more tricky. For the temporal method, for the lower cost or market, if it was the historical cost you're using, you would use the historical rate. If it was the lower cost or market, you would use the current rate. So you actually have to split your inventory up between those things that are cost or net realizable value. The net realizable value would go in at the current rate. We're just going to combine, we're going to say everything's at the historical rate just because, just to make it a little easier, but it could be actually have two different rates for that. Okay, so anyway, let's go ahead and see. Okay, so revenues. You'll notice that the revenues are at average. And again, that's kind of what you would expect because they sell things throughout the year. What color did I make that? Oh, I know, I could copy this over. I think they're the same. I know you guys are bracing for me to mess this up, aren't you? All right, 130, 22. I think they're the same. Ooh, look at that. Okay, so sales made throughout the year, they're going to be at average, and this should be the same as before. Hey, it's not. What did I do wrong? Yeah, I did it historical instead of average. Thank you. Okay, there we go. And we probably don't need the cents here. Let me get rid of those. Second. Okay, I'm back. Okay, so now we're going to go to cost of goods sold. Now, cost of goods sold, you know, what we are selling here is we're selling inventory. And you'll basically, when as inventory is purchased, every time you purchase it, you'll look at the exchange rate. And that exchange rate on the day is purchased. So for like in LIFO, FIFO, you know, had all those different levels, those layers. Each one of those layers will be converted to US dollars at the rate it is at that date. So not only will you have different prices that you paid for them, you'll also have different conversions of those dollars. And so you may have 50 historical rates in there. We're just going to use the one historical rate because, well, for one thing, that's all they give us. All right. Let's see. We'll make it peanut butter color. So inventory will go in that peanut butter color. Are you guys writing this down? Peanut butter color. All right. Okay, so the inventory will be, the cost of goods sold will be 383,760. So cost of goods sold will be at the historical rate for the inventory, and it'll be 383,760. Our gross profit will be 116,000 240. So 116,240 for the gross profit, and that would be a composite. And you'll see that's different than what we have here. Obviously, it's because we're using a historical rate instead, but it's still a composite. There's two different rates going there. So the gross profit at this point will be a composite. Okay, operating expenses without depreciation. Let's go over here. Most expenses are going to be on average. Your rent, your utilities, you pay utilities 12 times a year. It's going to be an average. You pay your rent, whatever. So most expenses are going to be at the average rate. Let's go to average. There. Now, depreciation expense. And I think in part of my streamlining, I cut off the part where it said that the property, plant, and equipment was actually purchased. It was actually there when we bought the place. So this is going to go at the historical cost of the first here. Because it was part of when we bought this company. I should redo this to have that in there. So the depreciation expense. Notice that this is different. It's not the average. It says, okay, on that date, this is what we bought, US dollars. Gain, question on that? Oh, I'm sorry. And the total will be 13,000. So operating expenses without depreciation, 62.5, which should be the same as the other one. This one will be 13,000, so it should be a different. It should be, well, was it 500 less? Actually, it's 500 more. The gain will be the same, 430. Look how much fun this one is compared to the other one. The other one was boring. This one's exciting. Okay, so gross profit. Bring them over here. 42,320, and this one is 48. Why is this one more? Oh, I know. You guys can tell me, why is this one, why do we have more income for the temporal method? There's actually one big thing there that's swinging it. Yeah.
$0.02 left.
Yeah.
And
Yep. Yep. Yeah. Notice that this is not the average. This is going in at the historic rate, which is two cents less, which doesn't sound like a much, but when you multiply that by 312,000, it makes a difference. So yeah, that's why this is going to, and now this one here is a little bit more expensive, the depreciation expense, but not enough to make up for that. There's only a 10,000 rather than, 300,000 times 2 cents is a lot more than 10,000 at 5 cents. So yeah, it's going to be a little bit higher. And this down here is going to be obviously a very composite rate. We got 1, 2, 3, 4 different rates there. I mean, you could actually see what the rate is for it but it would be kind of a meaningless number because there's no, it depends on all this other stuff, the weighting of the other stuff. Okay, beginning retained earnings, that should be exactly the same as before. That's going to be the historical cost when we bought it. Now, let me go over and make sure I'm saying that right. Yeah, So the first year it'll be a historical, subsequent years will be separate. And by the way, so they will have that every year, whatever the ending retained earnings is, that'll become the beginning for the next one, but it'll be a whole bunch of different composite rates in there. Because, you could have many different rates going through the years. Okay, so let's see, that is in retained earnings will be at that should be the same as before. So 197,600, that should be exactly the same. Our income is going to be this here. And I know what you're saying. Hey, how about an arrow? Okay. I didn't put an arrow on the first income. I should have. In fact, I'm going to go. When you make an error, the best thing you can do is just admit it. And so there's the income getting transferred down. Oops. And let's go back to this one. So we're transferring this composite income down. And again, it's a composite rate. You don't need to put that. Dividends declared should be at the same historical rate we did on the first one. $9,126. Same. And this total will be a little bit different because the income is different. It's gonna be a composite, but it's a different composite. Should actually be what, higher? The rest of the stuff's all the same. The income will be higher though. So retained earnings should be higher on this one. Let me check over this one. Yep. Okay. So let's go to the balance sheet. So our balance sheet here, no, let's go. No, here we go. So a lot of the stuff is going to be at the current rate. Inventory that's at the net realizable value would also be at the current rate. We're going to pretend like that doesn't exist, at least for now. So cash, whatever the current rate for the cash is, that's what it's worth at the year end. Accounts receivable, those are going to be paid off in cash. Marketable securities, those are going to be paid off in cash in the short term. So these are all going to go in at the current rate, just like before. And let me make sure I get the current rate. The current rate is really the year-end rate. I didn't go over the. Oh, yeah, right. I had it in the class I had about how it's harder to see colors when you're studying and stuff. I don't know what to do this. And I'm going to bore you guys silly with that because most of you have already seen it, but part of my job as an instructor is to bore you guys. Oh, I did this wrong. That right there is wrong. I would say that I was testing you, but I actually just did it wrong. And I did this wrong too. Okay, so first, this should be the same as the other one. 58, cash is $58,080. And receivables are 84,480. And that should be exactly the same as before. Now, the inventory, we're gonna need to put this on at historical cost. And basically it goes on at historical cost, unless it's the net realizable value. So inventories can go on at historical cost, which is $1.23. It's the peanut butter color. What rate does property, plant, and equipment go in at? Historical. So this will be from the first of the year when they bought the company. This inventory was there. Scratch that. This property, plant, and equipment was there. So this is what they bought. They bought it at the first of the year. So this will be a historical cost. It's going to be from the first of the year. A lot going on here. Oops. Okay, now unlike the other one we did, okay, so let me read these off here. Inventory will be at 123,000 and property, plant, and equipment is at 234,000. And the total assets will be at a composite. We have three different rates going on there. You don't need to put that in. Probably lower than this one, right? What was it over here? Yeah, so last time it was 512,000, some change. This just under. Okay, accounts payable. Those will go on at the current rate, which is really the year-end rate. And same with bonds payable. Check just to make sure I did that right. Liabilities. Oh, deferred it. We don't have any deferred. Deferred income, because it'll be in cash, is going to be a historical. What the cost was, what the exchange rate was when they changed, when the cash changed hands. Okay, so accounts payable will be at the current rate, which is really the year-end rate. Smart for both of these. Those will be exactly what we had last time. They should be. Yep. So 47,520 for the accounts payable, 47,520. Bonds payable, 158,400. Common stock should go back on at the historical. It should be the same also. Retained earnings. Whatever we got for retained earnings up here. Oops. All right, so common stock was 75,400 and retained earnings, and this is just from up here, will be 230,540. So 237,540. Copy that. That's the same as those. Okay, so let's add all these up. And the difference is gain or loss. Loss, yeah. We have 499,000-ish of assets. And we owe basically the creditors and the owners 512-ish thousand. So there's a difference about 12,000 there. So this will be a loss. Now this will actually go on. Oh, I didn't write what it is. It's a loss. This will actually go on the income statement. So even though we have our income statement, we have a little bit more income here. We have 48,000. We are going to have to subtract out 12,300 from that. So our income is actually going to be less overall because this will actually hit the income statement. It's, excuse me, it's hitting the income statement because it's basically in US dollars. These have completed the the full cycle of the local currency, making the sale and all that, and then those dollars being brought into the United States or US dollars anyways. These are completing the cycle of being repatriated home. And so this is an actual dollar amount that we lost on. So this will be oops. So our real income will be 48,060 minus 12, whatever, 26, no, 36,000, something like that. Question on that? Okay, here's your job. Problem 3. This is similar to problem 1. So problem 3 is similar to problem 1. Do that. And problem 4 is similar to problem 2. I will kind of chunk away at this a little bit also as we go along here, but whenever you're done with it, show it to me and turn it in. And those of you playing along at home, same thing, see if you can figure that out. I will be putting the solutions up here a little bit. But it's very similar to what the the other one. I think they're virtually identical, basically. Now be careful. When I say identical, the rates are different and stuff. So, I guess the dates are a little bit different. And by the way, those of you, feel free to take a break if. So this first one, this will be the current rate method. Hey, I don't think I put the method up on the last one, did I? I did not. This is the temporal method. So 2 is a temporal method, and 4 will also be the temporal method. Okay, so problem 3 is the current method. This is similar to problem 1. And this one will be the temporal method, which is similar to problem 2. Problem 4 will be the temporal method. Which is similar to problem 2. that three? It's three, right? Yeah. I think you should get net income of 75,845. Did anyone got something different? Yeah, it all goes in at the average except for the gain, which I think was, yeah. I think it's right. The important, and actually the important thing is to get this stuff over here, right? So these will be the, let's make up my own. So these will all be at the, be at the average. Put it in right which way? Yeah, I did it right here, just not right. Okay, so this would be. Are you done? Okay. Oh, you read them off to you? Here. You got the same as I do, right? All right. So first one, 896,000. Second one, minus 698,880. By the way, if you could probably, if you take the Word one, you can probably just copy it and paste it into Excel if you want. Yeah, I'll take it either way. Anyway, uh, so the gross profit, yeah. Question? Oh, just incredibly bored. Play me a bit. Okay, okay, so gross profit 197,120. Operating expenses without depreciation, 112,000. Depreciation expense, and again, this is kind of different than we would have for the temporal method because it's at the average. 22,400. The gain on sale was on 522, so that'll be a special one. That'll be a historical cost, 13,125, and then this will be a composite mixture there, so we don't really have one there. Ooh. And this will just come down here. It'll be the income. You retained earnings, this will go in at the historical cost at the beginning of the year. Let's give that a color. Orange. Oops. Okay, so the beginning retained earnings will be 353,780. The income will just be this. Income will be the same. Dividends declared and paid 7-1. Let's make a photo museum. Green. Green. Okay, so the income will be exactly the same, 75,845. Dividends declared and paid will be 27,090. And that's because we paid them on that date. You know exactly what they were worth. That'll be 402,535. Balance sheet. For the current rate method, it's really kind of fun to do because it's all the same amount. Going to be at the current. And although it says current, it's really current really means year end. Not exactly sure why they call it current, but let's not worry about such things. And this one's actually not at a composite. This will actually be at the exact same rate. Okay, so let's see here. So before I get too far into this, let me make sure I grab the right one. Current rate, which is actually the year-end rate of $1.35. Okay, so coming down here, the first one, 77,000 will actually be 103,950. So 103,950 for cash. 151,200 for receivables. Inventory will be 236,250. Property, plant, and equipment will be 425,250. So inventory again, 236,250. Property, plant, and equipment net will be 425,250. And total assets will be 916,650. That is, that is right. Well, it's right according to me. Yeah. Yeah. And by the way, you guys feel absolutely free to take pictures. I don't mind it at all. In fact, I encourage it. Okay, so let's see. Accounts payable and bonds payable, this will be the same. Okay, so accounts payable will be, oops. So accounts payable is 85,050. And bonds payable will be 83,500. Common stock will be as of the first of the year. It'll be historical. Do I have that one already? I do. And it is. So common stock will be at $1.33. Let me make sure I'm doing that correctly. Yes, it is. $1.33. So the total for common stock will be, and these are in US dollars, 134,995. Retained earnings will be the same as up here. Maybe I should try to get those both on the same screen. Okay. So this is our ending retained earnings. You want me to put the arrow in? No, not the stupid arrow. Oops. Hey, how come the stupid arrow is at a different length? Should be the same length, I would think. These up. Let me read these off to you guys. Okay, so common stock is at 134,995. Retained earnings is still the same as up above. It'll be at 402, 402, 535. And the total will be 906,080. And the difference is some number, like 10,000 something, I think. 10,570, and check and see, it looks like I had exactly what I came up with before. Okay, so, gain or loss? Good, gain. So that'll be a gain. Hey, now these don't match up. Oh, they do. Okay, so, and this is the, I just realized now why I can't be crunching these columns together, because, I should make that into two anyway. Okay, so this will actually be it'll be a gain. It'll be in the equity section. It will not be on the income statement. It'll go right directly into the equity section. So coming over here, so this is when we combine the two companies together. Somewhere in here, they would have that line item of 10,000, whatever. 10,570 would be plugged in here somewhere if this was a consolidation. Somewhere here in the liability, excuse me, the equity section, we have that 10,570. And again, it doesn't go through the income statement because it's not in US dollars. It's not what they, we term as a completed cycle for the US company of the repatriation of the dollars. And it may never be repatriated. Bring it in the United States, you got to pay US taxes on it. Maybe you got it someplace where the taxes are low, and why bring it in if you don't need it? Question on that thing? Are you guys done? Well, bring them up. I'll check it in. And I do have the solutions here. This will be the same as I got. 14.3. Yep. That's it. We're on week, what, 5? Yeah, do far.
I have to finish this. This picture.
Well, okay, so
That's not big.
I'll take those changes.
Oh, thank you.
23, 125, 28. Yep. I think the inventory should be at 27. Is that a step?
Inventory?
Yeah, the historical inventory will be at 27.
Oh,
135 to 135.
yeah, this one is not wrong.
133, this one. Yeah, that one's right. This one, everything
Yeah,
else is
only-
right.
Thank you.
What was your name?
Oh, wait. Wait, Neil.
Yeah.
Thank you.
Thank you. Luke.
Taking the person out to the main, like, what?
Nope. Nope. Yep. What's your name? Stable. Yep. Very good. Yeah, if you're turning in, you do not need to turn it in Blackboard. I'll put these in separately. Yep. We're just supposed to be out of country or something?
Yeah, but on the 20.
Oh,
Yeah.
not that we don't like you having here, we do, but, oh wait, here's the solution.
And then I missed last class, but I already turned in all of the like
It's in Blackboard.
Yeah.
Okay,
Be a blackboard.
I'll be putting that in shortly. Okay.
in person, or talking to later out.
You know, you probably don't. I mean, when I put them in, I don't, separate that out, you know. I do write it down in here, and if it ever came up, I would, you know, show what I have, but I wouldn't worry too much about it. Yeah, it's required that we actually have the 8 classes. It doesn't really say that if you miss a class, you know, you get sick or something, you know what I mean? So anyway, as long as they're attending, it should be fine. It is kind of weird nowadays. I mean, it's kind of,
Yeah, because I have to wait 1 hour
yeah.
to get, I only have 1 class today
Yeah.
at work, so I think I'm so glad you have the Zoom class. So yeah, we have in person and Zoom.
Yeah, right.
Yeah, that's not good. Thank
Okay,
you.
yeah. No problem. You sent me an email, didn't you? Oh, I know. I didn't post the video. I remember. Yeah, I'm glad you said that because I completely flaked on it. I usually do it right when I get home. And I run it through an editor because if I don't, it kind of goofs up in YouTube. So if I run through an editor, it usually just whatever. It usually works much better. So I will do that though. Yeah. Okay. Yep. You sent me something, didn't you? I can't remember. Okay, those of you playing along at home, I'm gonna put up the chapter 3, or excuse me, problem 3. So here's problem 3, the first half. Let me get a screenshot of it. And problem 3, the second half. Oops. And this is number 4. See you guys. This is number 4. Move down here. Let me zoom in a little bit so we can actually see it. How about? So this is the first half. And this is the second half, which, yes, that's right. Okay, good. So this is the second, the balance sheet. Any frozen? Any questions on the from the home people?
Nope, no questions for me.
Okay, so that's all we're doing. So you turn that in. Thank you. So yeah, Alex. Thank you, Terry. Okay, so yeah, if yeah, so just go ahead and turn that in. I think there's a spot for it. There should be a spot for to turn that in. But yeah, and then next week we'll do the practice exam for those two, and I'll send out the exam. Next week we're also in class if you want to come down. But other than that, next week will be the practice exam and then the chapters 6 and 7 exam, and then the week 7 we're off. Okay. Okay. Good night, guys.
Sounds good. Thank you.
Thank you. Have a good night.
Hello. You too. Thanks, Tim.